everyone, and I'm very excited to introduce Chinu Gupta, our esteemed fund manager from HSBC AMC. Chinu is having rich experience of 18 years working in this industry, and she have joined HSBC as a part of the L&T Investment Management team. Prior to that, Chinu was working with the Canara Robeco AMC, where she worked in equity as a fund manager, and she was managing few of the schemes there: equity tax saver fund, equity hybrid, consumer trends, small cap fund, and infrastructure funds. Chino is a CFA chartered holder from USA and has completed her PGDBM from SPJ in Mumbai, where she is a gold medalist in her finance specialization. So, yeah, we have Sanjay Sachdev also with us, and who is a business development head, and he is also pursuing the experience more over 2 decades. So, yeah, I would like to give a warm welcome to all our partners and my dear colleagues. So, I'm sure, I'm very confident, in fact, that today's session is going to be very insightful and beneficial for all of us. Further ado to this, I think let's welcome Chinu Gupta and make the most of this opportunity to learn and grow together. So, over to you, Mr. Sanjay, and then after Chinu will take the presentation. So, thank you so
Thank
much. Over to you, Sanjay.
Thank you, Disha. Thank you for this introduction. And thank you, Team JM, for giving us a small platform to address the partners here. Since we are doing this call for the first time, I thought before I hand it over to Chino, I need to give some background, some introduction to the entire team here who have logged in for the call. So first of all, yes, I think I'm sure as HSBC, you must be hearing us for the first time, but I'm sure as the team, as me or Chinu, you would have heard us in the past also, because we all have come from L&T Mutual Fund. As you are aware, in November 2022, L&T Mutual Fund was taken over by HSBC Mutual Fund. And since then, we have been part of HSBC, and the integration is well successful and one of the most smoothest integration which has happened in the country. First of all, the good part is Kailash Kulkarni, who was heading L&T Mutual Fund CEO, was the CEO in L&T, continues to be the CEO here in HSBC. Our equity CI head equity, Mr. Venugopal Mangat, continues to be the CIO equity here in HSBC Mutual Fund. And same goes with Sriram Ramanathan, who was heading the fixed income piece for L&T Mutual Fund for 10 years, now continues to be heading the CIO for fixed income. Venugopal and Sriram Ramanathan both report to Kailash Kulkarni. So why I'm highlighting this is every employee of L&T Mutual Fund, right from the CEO till the last RM, came on board on HSBC. So basically, the entire team remains the same because what matters to y'all is whether my ground team, the team which engages with y'all, or the core management or the core investment team has remained intact. The answer is yes. The entire team has remained intact that way. So that is the first piece which I thought I need to update y'all. Even the philosophy and the investment processes have remained the same what we used to follow in L&T Mutual Fund. So there is a strong continuity here. So one did not wait for a longer time to say whether I would want to go ahead and deal with HSBC Mutual Fund. Yes, definitely the team has got stronger because HSBC team also got merged with the L&T team. And now we have 5 to 6 investment fund managers. We have close to 8 research analysis. We have close to 5 dealers, which makes a 16-17 member team on the equity side, and same goes on the debt side too. So there is a continuity of fund track record remains intact. The good part is last 15 months post the integration, the performance of majority of the funds have come back. They are all in the top 2 quartiles. The moment we integrated in 2022, early Jan, we had a first multi-cap NFO. Happy to share it has been a good track record which has got built. I'm sure some of your clients would have invested in the NFO way back almost a year ago. The NAV as on date stands 15 plus, which means the investors have got more than 50% return in the less than 13-month scenario. The reason I'm highlighting this is because it's a top quartile, rather number one ranked fund in the multi-cap category in the last 12 months. We also had a consumption fund NFO in the month of August, which also has been doing well. So the good part is once you start well, your half the journey does. You begin a journey on a positive note. Today, Chinu is with us. She's going to highlight about the way she looks at the market, certain parameters which will be highlighted by her about why she believes the market should dwell well over the next couple of years, couple of decades for India. But before that, we are going to speak on multi-asset fund NFO, which has got launched by HSBC couple of weeks ago. The fund NFO is coming, rather closing this Thursday. It's a short time, but we thought it's important to highlight. The good part is, as I'm sure you would have sold a lot of multi-asset products in the last couple of months. A lot of competition have raised. They have launched NFOs in the last couple of months, and you would have allocated money. We believe this is a very good asset class to be into. First is it gives you so our fund is a equity taxation product. Step one. Step two, we all understand this asset allocation or is a key for any returns or the wealth creation process over a longer period of time. First allocation goes to equity. I mean, we all have skewed investments when it comes to mutual fund or equity. Such category gives an advantage to you of having exposure to equity, arbitrage, debt, and commodities. And in commodities, we would take exposure to gold and silver also. So the key parameter, and this is one of the rare years where we believe over the next 15, 18 months, your all the three asset class, equity will volatile. We all know equity would give positive returns over a period of time. Debt, we all know the entire world is looking for a debt rate cut, which has to happen. So when there is a debt rate cut, definitely it benefits debt funds. Third is commodities. Because of geopolitical issues going on across the world, we believe commodities can also give an upside. So this is a broad framework which I thought I need to give a heads up to you before I hand it over to Chinu, who will take across to this small presentation about why she believes equity and India are correlated and will do wonders. Over to you, Chinu.
Thanks, Sanjay, for that introduction. And yeah, happy to talk to the team and take you through this presentation. Why presentation? More because whatever I'm speaking, just to put it in few slides, I think it puts good weightage. So just a second. Okay, I'll just take you through this. You'll see this multi-asset allocation fund?
Yes, it's visible.
Yeah, it's visible. Yeah. So I think let's start off with why we are talking about these three asset classes, right? To give a backdrop. So very important to talk about why we are looking at multi-asset. Look at the equity volatility that you would have seen over the years, the debt volatility that you have seen over the years, and the various performances now that you can see over the years, right? So what you see here is that look at the year 2008, right? That the first one that you can see. 2008 was the first year where we witnessed tremendous volatility in equity, where equity cracked almost 50% plus. But it was almost in this year that gold stood up and gave you 26% returns. Talking about similar event in 2011, you all might not have that backdrop, but 2011 was the year in which most of the countries were running towards financial crisis of their own. And there were a lot of downgrades that were happening across countries. So talk about Spain, Portugal, Italy, Greece. We all remember what was happening. And that was the time that again equity cracked. Whereas gold in this time gave you return of 30%. So this is usually what happens, that whenever asset class of equity cracks, you have something like gold, which is standing up and delivering. And somehow we see that these are the times that this geopolitical uncertainty kind of tends to continue. Look at the environment right now we are talking about. So I'm not talking about COVID. I think COVID is too fresh in our memories, where we knew that in 2020, March, what happened? Where equity corrected by 30%, whereas gold in that same period rallied by 30%. Today, as we are talking, the geopolitical environment is there's a lot of turmoil in the environment. You have three conflicts almost going on simultaneously as we are talking. Not to say the good thing is right now India directly is not involved in those conflicts, but there is no denying or saying what could happen next year. So it remains a very difficult environment, and hence in this environment, I think gold and silver find their rightful place in the portfolios. Maybe some years earlier one wouldn't have said so, but looking at the situation right now, I think this is the good mix that one needs to have in the portfolio. Quickly, just talking about the volatility, I think important to see here, what we have done is done a combination of multi-asset allocation. So in multi-asset allocation, you have the purple bar that you can see here. It's a mix of equity, 65% equity, 20% debt, 10% gold, and 5% silver. So we just created a combination of all these asset classes, and this is done right from 2007, which is taking care of all the big negative event that you can think of that was considered. In the red bar, you can see the equity performance, right? And black is debt, and gold and silver in their respective colors. Now look at the average return that these classes gave. In the first left-hand side, you can see that the average return given by multi-asset and equity are almost similar. And now go to the extreme right-hand side, which is the volatility part that you can see. When you go to volatility, you will see that the returns, the volatility of the equity and multi-asset, there's a big difference. So multi-asset volatility comes down to be far lower. I think this is the kind of scenario that we're talking about, that if the returns can be matching and the volatility can be very different for the two funds, I think this is what creates a different platform for the investors. And today, if you're talking of the environment, yes, markets have run high. Equity story, no doubt, is strong. We'll be talking about it in more detail. But even at those higher valuations, if one has to participate in the equity theme, I think a better way to enter the market at these times is through funds like these, which is like multi-asset. I would have said hybrid funds, which are either ways a mix of equity and debt, but multi-asset gives you the added advantage of having gold in it. So entering the markets to participate in the equity stories. So the idea is definitely to participate in equity story, but to take care of the volatility, this is the kind of product that one should be looking at. So this is what we want to tell the investors. So I think very important to get this takeaway of the average return versus the volatility of this product. So I think as Sanjay has mentioned, this is how the equity allocation will be. We'll have 65 to 80% allocation in equity. How we'll be looking at it, the approach will be top down plus bottom up. So it will be a combination strategy that we'll use. The style will be again blend, growth as well as value, combination of both. Debt, again, the idea here to generate alpha would be through duration, because we'll be sticking to G-Secs and AAA kind of securities. Gold and silver, the allocation would be about 10% to 25%, again, in the maximum scenario. What additional thing we're talking about is this arbitrage. So arbitrage is something that can be used within the equity portion if at all we have a very negative view on the markets. And the reason for having negative view can be dual. Either we can say that valuations are making us extremely uncomfortable across categories. Like we all know the scenario, right? In between, mid caps have become very expensive. Small caps valuations have inched up. Large cap is still giving you some comfort. So I think this is a variety scenario. But if at all valuations were to become expensive across market, then maybe we'll use arbitrage and get down the net equity exposure to even lower. And it could go down to almost 40-45%. So valuation could be one of the reasons for getting arbitrage in play. Another reason could be if we develop a negative view on the market. And here the reason could be any domestic event politically, which we believe could be negative for the market, say for 6 to 12 months. We might use arbitrage. Again, globally, if a situation develops because of which there's extremely negative view, we can use arbitrage. So this is something which we'll use to cover on the downside, that we believe that, okay, there is risk to the equity upside, so we'll reduce the equity exposure only in that event. Otherwise, this is how the allocation overall to the fund will look like. Right. And This is the theme that we are talking about. So equity, I'll just broadly take you through the various themes in equity. The first being the manufacturing theme that we are talking about. I think this theme is well understood now by the markets. Various initiatives that the government has taken, be it RERA, be it GST, and the latest one being PLI. I think all these initiatives are extremely positive for the manufacturing space, giving a good development to the manufacturing ecosystem as such. Now, this is something that did not exist in the market, at least in the domestic market. We were not a manufacturing hub, but slowly and gradually you will understand how government is promoting the backward integration. And it's important to note the way PLI is targeting the backward integration. So you do not get PLI on the front end product mostly, but you get it when you are manufacturing the parts, so you're doing backward integration. So I think this will lead to good, healthy development of manufacturing ecosystem. Understood. Apart from that, infrastructure, again, you know, the budgetary allocation that has been happening in infrastructure, extremely positive. In fact, we've been seeing 25% plus CAGR kind of allocation in the budget happening to the sector. So that is definitely a positive for the equity market. Coming over to sectors like power, which need great investment. After like 10 years, this sector is about to pick up. A lot of investments will be needed here. Again, financials, the good thing is balance sheets are extremely healthy. Talk about PSU banks, talk about private banks. This is one of the best times. NPAs are at the lowest. And when I'm saying best time, I do not mean directly best time for banks. What I'm saying is it's the best time for the country as such to start the capex cycle. Because when banks' balance sheets are clean, NPAs are low, it's very easy to start the lending cycle. Even the corporates right now in India have one of the lowest debt, and the cycle could pick up. So that is why we are positive here on the entire capex cycle because of good balance sheet of corporates and banks. Talking about Make in India, obviously understood through manufacturing. Apart from that, discretionary consumption, because today we are talking about India being the at a spot where demographically we are one of the best placed. Look at the average age of an Indian. Uh, it's about 28, 29 years. If I compare this with any other country globally, we are one of the youngest. China today stands at almost 35 plus. US close to 40. Talk about European nations, they are even higher, 40 plus, 42, 43. And obviously, Japan is close to 50 years. So, versus almost all the other nations that we can talk about, I'm leaving the African continent aside where the age is lower. I think we are one of the youngest nations, and consumption goes, I think, in tandem with age. So, the consumption which comes at the age of 30 and below is far higher, the rise in consumption, compared to what is coming at the age of around 40. So, I think that is a big gap. What you're seeing, the per capita rise in GDP, that also will be the sharpest in this decade. So we've used the previous decade to bridge the poverty gap. What was happening in the previous decade was just households moving from below poverty to low middle class kind of range. This will be the decade where you will see the premiumization playing out, which is one of the sharpest when it comes for discretionary consumption. So again, that theme is amply positive. So all in all, we are saying this is a strong decade to be present in equity, very important for domestic market. Debt, we all understand that interest rate cycle is about to turn, be it the Fed rate cut, which we are talking, which will happen in next, maybe from March to June, anytime. And the following in the second half, we'll see RBI cutting rate. So that stands. Again, inclusion of the bonds that we've been talking about in the global indices is a healthy positive for the debt market. And I already spoke about the role of gold and silver in these times of geopolitical uncertainty. So all in all, we are saying that this is where we see this multi-asset fund to be well placed and taking care of the volatility which comes at these times of higher valuation. Yeah. So this is what we had to say. And yeah, thanks. We'll be happy to take any questions.
Thank you so much, Chinu, for the wonderful presentation. And on behalf of JM Financial Services Limited and my entire IFA-based partners, I would like to extend a sincere gratitude for your insightful presentation on HSBC Multi-Asset Allocation Fund, for your expertise and deep understanding about the subject. Actually, it was truly evident. and we appreciate the time and effort that you have put into sharing your knowledge with us. Thank you so much. So now we'll move to last segment, which is Q&A. So let me just put the few questions we have received from all our partners on screen. Just a minute. Huh? Yeah, so I'll just read out the first question for you. Is it good to invest in multi-asset allocation fund from conservative investors' point of view?
Yeah, I think that's a very good question. So that is, I think, the entire idea which we wanted to start. Several investors would be feeling that this is a very delicate time to be in the market. Valuations have run up high, and we share that concern. And the idea is to say that when you are with the multi-asset allocation fund, this asset allocation fund will ensure that if the equity valuations are extremely high, there is a healthier allocation to other asset classes. So from conservatism point of view, it makes good sense. Even for aggressive investors, it is not a no-no, because in times where equity is looking favorable, the allocation of equity in this fund can go up to almost 80%. So what I would say is this is not a product maybe for a conservative investor or an aggressive investor. The nature of the product is such that if at all there is any support needed in terms of any concern emanating from higher valuation or geopolitical concerns, we can take the equity proportion lower. This flexibility is not there in the normal equity funds. I think that is how I would want to put it.
Yeah, thanks, Chino. So my next question to you is, most of the HSBC funds are not in top 5. Many multi-asset funds are available in the market. Why to choose HSBC? Any specific reason?
So again, the way we want to see the funds in this market, which is racing for returns, it's a very erratic measurement of taking in top 5. I think the good way to looking the health of a fund is to see the quartiles in which the fund are present. And anywhere the fund who is present in first quartile or second quartile, I think that's a respectable return. Because at these times in the market, the environment we are coming from. Many a times fund may be taking undue risk to reach in the topmost notch. But at HSBC, you believe in giving a healthy mix of returns as well as risk. And I think that will be amply visible from the quality of the holdings that we have.
Sure.
So that is one thing I would want to say. Apart from that, I think Sanjay also mentioned in the introductory call, the multi-cap fund that we have, it's not just top 5, it's in the top 1, 2, I believe. Even the consumption fund that we've launched, not very old, but that also would be there in the top 5. So it's not that the funds are not in top 5. What I would again say, but idea is not to look at the funds in top 5 in this time of the market. These are very volatile markets. It's better to look at the risk and return combination, and hence look at the funds in the, at least in the quartile basis, not just funds who are gunning for returns.
Correct. Yeah, thank you for the brief, and let's move to third question, which is, any specific reasons why so many multi-asset allocation NFO issue at this point of time?
Yeah, I think very good reason that we are saying that markets have run up to higher valuation. And had we had negative view on equity, we would have said, okay, just look at the debt funds right now because debt is in a positive cycle. But I think this is one of the cases where we have good positive view as I think entire houses, mutual fund houses have a positive view on equity. At the same time, debt, you have a positive view. So when you have a positive view across asset classes, and the way we said, even gold and silver look positive because of the geopolitical tension that we are seeing around. Such times become very favorable for funds like this. Hence, maybe various fund houses are finding the same thing and they're coming up with this. We at HSBC have this additional advantage that globally HSBC has a significant amount of AUM which is already being managed under multi-asset allocation strategy. So almost $150 billion plus is being managed by HSBC globally under this allocation. So the platform is, I think, well versed with this. For us to get expertise at any point across any asset class, it would be very easy to get it from that platform. So that is another advantage that we here have at HSBC. And yeah, timing suits one and all.
Correct. So my second last question to you is, which sectors are you focusing on when especially the elections are around the corner?
So interesting question. This is, I think, the first time since the memory I have, the elections of 2009 were very dicey. Election of 2014 were very dicey. These were the years that, as portfolio manager, you prayed, you didn't want to be there, because how to construct a portfolio when you didn't even know whether you will get a stable government or not. So very tricky times. In fact, even in 2019, we had that kind of dilemma that whether continuity of policy would happen or not. This time round, I think the jitters are minimum. Obviously, it's an election year, nothing can be ruled out. We have to keep that caveat in mind. However, when it comes to, for us, that certainty of policy continuation, again, I would say, not the government, this time it looks like that continuation of policies is far more certain. So when it comes for portfolio construction, these are luckily not those tricky times of election year. We are still betting on infrastructure as a sector we'll be bullish on. We'll be bullish on the manufacturing space and discretionary consumption. So discretionary consumption can be very tricky. Where once it's down, people might feel it's over and out. However, it's a one good healthy theme which will survive. So you might have cyclical downturns in pocket of discretionary consumption. Sometime QSR might go down, sometime apparel or footwear might go down. But then hospitality rises, jewelry rises. So you will have pockets and discretionary consumption which will keep on rising. So again, this space will be one of the space which will be positive.
True. Correct. Thank you. And this is the last question. As you said, 80% will be equity, then it will be high risk on the equity side. So how you construct the portfolio of equity? Is it large, mid, or small cap?
Yeah, I think good question. So what we are saying is, if we find everything very attractive, including valuations, then it will have 80% equity. Otherwise, the range is 65 to 80%. Right. So generally, like the scenario it's now, where we feel valuations are a bit higher on the higher side, we'll start with 65%. So it will be 65%. But how we are looking at the construct of large, mid, and small is, we view large caps as something which gives stability to the portfolio. So they are there for stability. They are there for dipping into when there's any uncertainty, you get liquidity in the fund. So that's the role of large caps in the fund. Little bit, you may say that they are not very aggressive on the growth, but yes, they are there to take care of the stability part. When it comes to alpha generation, that would be done mostly through the mid and small cap allocation that happens, because these are the companies which are kind of doing better than your large cap companies because of the size, because of their aggression that they can find in environments like this. When I say environment like this, we are talking of an environment where GDP growth is cyclically picking up. As we all know, we are coming from an era of 5.5% kind of GDP growth, now inching to almost 7%. So even the next year GDP growth outlook looks above 6.5%, which is very positive. In such environment, mid and small cap companies tend to do better. So we are just on the lookout of time when we can get good valuation in these companies, but then these would be the alpha generators for the fund. So you can say that there will be a healthy combination across these large, mid, and small categories. Hello.
Disha, you are on mute.
Yeah, sorry for the delay to all our partners. And I think it was a wonderful session, very informative and valuable to all of us. And we'll definitely see for such engagement and collaborations in future once again. So thank you all our partners for joining on time. Thank you. And thank you, Chinu, for the lovely presentation. Thank you. We can conclude the session.